In this week's special holiday edition video, we'll review the latest charts and data to help us answer the question, does weak stock market breadth point to disappointing returns in the years ahead? We'll be moving quickly, so feel free to use the pause button on your video player. Source of the data, Ryan Dietrich. His Twitter handle or X handle is in the lower center portion of your screen. He's with the Carson Group. December 16th, 2024 ended 14 consecutive trading days with negative stock market breadth. As shown in Ryan's table, a year later, the stock market tended to do well. The average gain was 14.8%, the median gain was 12%, and 87.5% of the cases saw the stock market higher. Since we're longer-term investors, we wanted to know, how do the S&P 500 and NASDAQ 100 perform in years 2 through 5? And that's walking forward from these dates here on the left side of your screen. But first, we're going to look at these dates and compare them to the present day in terms of the strength of their trend. We've got the 20-day moving average in blue all the way out to the 250-day moving average in black. Chart is dated September 10th, 1991. That's the first signal date from Ryan's table. All of the charts that we're looking at will be 4 years, and you can see this chart, for the most part, has been moving from the lower left after the 1987 crash here to the upper right, and we're very close to having a full-bore bullish look. Quite a bit of volatility between point A down here and point B, but an uptrend nonetheless. Similar situation if we go to the second signal date, August 13th, 1992. The chart is clearly moving from the lower left to the upper right with 100% normal and to be expected volatility between point A and point B. The April 4th, 1994 case looks a little bit different because the market has already taken a plunge on the signal date. So the chart's April 4th, 1994. That's the date of the signal, and that would be similar to December 16th, 2024, after we've seen 14 consecutive days of negative market breadth. In the 1994 case, it was 8 consecutive days. But the 1994 case does help us keep an open mind about worse than expected outcomes in the short run, and that's a healthy thing. June 20th, 1996. For the most part, a full-bore bullish look. Chart is clearly moving from the lower left to the upper right. Relative to the charts and signal dates that we've covered thus far, September 21st, 2001 occurs within the context of the dot-com bust bear market. It really doesn't look like the previous charts. From this point here, this chart's moving from the upper left to the lower right, and we're very, very close to a full-bore bearish look on the signal date, September 21st, 2001. Similar situation, October 10th, 2008. Bad things have already happened. Really bad things. The S&P 500 peaks here roughly a year earlier in October of 2007. And we walk forward to our signal date, October 10th, 2008. The 2008 chart really doesn't have a lot in common with 1991, the signal date in 1992, and it's even significantly different from April 4th, 1994. All three of these cases, the longer-term trend really doesn't look anything like October 10th, 2008, and that would be true for September 21st, 2001 as well. How about the 2011 and 2018 cases? How do they compare to the recent case, December 16th, 2024? August 2nd, 2011, from here to here, it's a strong trend. However, there's a lot of overhead potential selling pressure in here from the peak in 2007. And like the 1994 case, on the date of the signal, December 24th, Christmas Eve, 2018, bad things had already happened. In fact, this was the date of the market low. I think ultimately the moral of the story from those charts is that these type of signals, similar to what happened on December 16th, 2024, they can occur in a wide range of market conditions, from strong uptrends in 1996 to ugly downtrends in 2008. But ultimately, what we really care about, since we've already hit our signal date in 2024, it's in the rearview mirror, how do the S&P 500 and NASDAQ 100 perform walking forward 1 to 5 years? We already know from Ryan's table that the S&P 500 performed well over the next 12 months. So now let's take these same signal dates on the left side of the screen and look at the longer-term performance, looking out 2 years, 3 years, 4 years, and 5 years from the date of the signal. And as you can see, the results help us keep an open mind about better than expected long-term outcomes. 2 years later, the S&P 500 was higher by roughly 34%, 3 years 54%, almost a 76% gain from the date of the signal, looking out 4 years, and almost 96% looking out 5 years. And in every single case, the stock market was higher between 2 years out and 5 years out. How about the NASDAQ 100? As you might imagine, the performance was even better. Average gain 2 years out from the date of the signal, 55%, 3 years out, 104%, 4 years out, 163 and change, 5 years out, almost 189%. So this table here, and Ryan's table, coupled with trends in the date of this signal that look significantly different and include strong bullish trends and strong bearish trends, it probably means that we shouldn't be overly concerned about weak market breadth, and we should continue to take it day by day with an open mind about a wide range of outcomes. There's nothing in this table nor this table that contradicts the secular trend thesis. And we all know the only way that we're going to be able to use all of this effectively is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.